Hello, welcome to Macro Point of View special show about the gold when we will try to establish is it overpriced or undervalued in the current circumstances on the market. We'll take a look on stock market, we'll take a look on real estate, on inflation, on a big macro index, we'll take a look on gold silver ratio, so there will be a plenty of information and probably we'll find out the truth. Is the gold overpriced or undervalued? Please stay with us. Don't forget to subscribe our channel. Please rate this show by leaving a thumbs up and share it with your friends in social media. Let's start. So let's simply begin with our information. For the very beginning, I must say that there is some issue regarding the valuation of gold prices. Because first, we've got the currency. The gold currency for the futures market and for the physical gold market is basically US dollar. The US dollar is not only considered with gold value, it's also considered with value of United States economy, of current situation, of geopolitical risk, of everything that is taken into the consideration by the world investors. So there is current currency issue with the gold prices. There's also a valuation of benchmarks because if we have a bubble, we mostly don't know it. We know it after it crashed, like we did with the dot-coms. Many people was saying then that there is a bubble, it's keep rising and it's a bubble, but it burst, so everyone knows it was true. We had the same on Tesla stocks in the past couple of years. We have some sayings that there was a bubble on a Bitcoin when it reached for the first time $20,000. And we know that it was a bubble when it reached $60,000, but maybe in 10 years or more or less, we'll see a much more on a Bitcoin price. So we'll take a closer look and say that, okay, $60 wasn't a bubble, it was all-time highs and we just dropped down. So the valuation of benchmarks is also not so sure. It's a subjective complementary thing that might be affected by other things, not only by the gold prices. Also, geopolitical situation, it changes so fast because we had a pandemic recently. We still have a war in Ukraine, the war that is in real terms a war between Russia and Ukraine supported by NATO. It's much more supported than it was Russian versus NATO in Syria. So this is something different. And it's also in Europe, and in this conflict we have, for example, threatened by Vladimir Putin that they're gonna use some tactical nuclear weapon which will be very unusual and will bring any worth to a completely new level. Also, we've got unstable situation with economical growth in China, in United States, in many other countries. So this also geopolitical situation might change. In the moment of recording, the Nigeria was pretty calm, but it might get much worse till this episode has a premiere. Also, we've got demand and supply, which we also will keep talking on it. So let's take a closer look on the charts and numbers. With those issues that might be, and there's probably not most issues or all issues that is into consideration by evaluating the gold prices, we must take something as a base. Because if we go with, we cannot set up the currency levels or the benchmark order in proper valuation, we won't be going anywhere. So let's take those numbers we have, regarding having in mind that there might be some issues, like I mentioned here for examples, and but yet use the current situation because those numbers are seen by everyone else. And the geopolitics with gold prices, we've got here a weekly interval. So we've got here at first all-time highs by pandemic levels when it burst in Europe and the United States. Then we've got Russian invasion of Ukraine, and now we have economical concerns plus falling on the US dollar due to some claims or ideals that it will be end of Federal Reserve in United States rising rates for United States, which makes dollar weaker. And yet those three things are here creating all-time highs or historical highs for the gold prices, and it's in about last 3 years. So it's not long distance. Also, we've got here US dollar index, which is currently since 1999 having 6 currencies with euro over 57%. This is because Germany, French, Spain, Italian currency was simply changed into euro, and it was simply changed without rebalancing the US index dollar in 1999. So for me, it's a pretty wrong thing to have euro as 57.6% part of US dollar index, but this is the way they set it up. They're not planning to rebalance it. Also, there were some calls claiming that Swedish krona and Swiss franc should be replaced with Brazil and China currency. And probably before Russian invasion on Ukraine, it will be also probably some voices saying that Russian ruble should be taken into consideration to be set up in the US dollar index. But yet, it looks like this today, so we cannot do anything about it. What is the current... one more thing I will show you here, because as you can see, we've got all-time highs on US dollar index in the mid 80s. Currently, those 21st century highs after setting the euro is 121, which was set up in 2001, and the lowest were in 2008 during the financial crisis. Here we've got of course earlier information about the setting euro in, so there were changes in US dollar index. And yet, according to these levels, we might say the dollar is too high. The dollar is too expensive, which also brings us into consideration that gold might be undervalued because the dollar is too expensive. And of course, it's for some people they saying that dollar index should be valued as 100, yet there are also different economical schools and things to taken into consideration with this. But taking a look that in the past 23 years we go from 70.6 to 21.1, well, we are closer to highest than the lowest, so I think we are a bit overpriced with dollar index, which makes undervalued for the gold itself. And then we've got central banks, and this is a lovely chart. I was really surprised by seeing it. I've heard some rumors, I know some details, but now with the full chart I see some difference, because as you can see, there was a major change after financial crisis from 2007-2009, after collapse of Lehman Brothers, after this real estate crisis. We had a big short movie about it. Great movie, watch it if you still didn't. And before that, since collapse of USSR, the central banks in general were selling gold. After the financial crisis, they started buying with the record level of over 1,130 tons in 2022, and there is some claims that this year 2023 central banks will be buying net over 1,000 tons again, which means even with those high prices attacking or reaching $2,000 per ounce in 2023, the central banks thinks the gold is undervalued. So they probably think, well, it's better to have gold than not have, even with the 2,000 price per ounce costs. And then we've got the gold silver ratio, which is mostly in general claimed as the best to establish gold value regarding to the second precious metal, which is silver. And here we've got 80 ounces of silver we need to buy one gold. How it's look on the other way? Here I set up gold silver ratio with Fibonacci levels. I set it up on pandemic highs and with first quarter of 2021 lows, and it looks like it's undervalued because it's under 50%. That gold is not so expensive, it should be around 100, but for me personally, I think of any level between 65 and 85 is fine with gold. Anything above 100 means the gold is overpriced. So for gold silver ratio, I think it's just a little bit undervalued. And inflation level. When we start talking about the inflation level, we must take into consideration one thing. Bretton Woods system, which collapsed in 1971 when there was end of gold in the currency system. And we begin our paper money, the known very well as create of inflation. The inflation that we experienced last year and this year, it wasn't only the Russian invasion, it was also the price for end of Bretton Woods and recent, including pandemic, but before that, printing money by the most governments around the world. So let's take a look on the CPI index and gold, and its all times is here. We have it since 1924, so just at the end of the big recession. And the gold we've got from 1965. But what about the last 20 years? And it looks like it was rising together. We had, of course, higher in gold prices during the crisis, the financial crisis 2007, 2010, then in 2009, then we've got first all-time highs in after the financial crisis, and it's keep rising. So it looks like the gold is a bit better, but there's also other side of this coin. We've got some website that is US inflation calculator, and it's claimed that $1 value in 1972, half year after Bretton Woods system collapse, to buy a goods worth $1 in 1972, now today we need $7.30. Too much? Too low? No matter. This is the inflation rate, the cumulative rate of inflation. So gold price in January 72, I set this date because it's a couple months after Bretton Woods system collapse. It's 47.6. So how much should gold cost today at the end of July 2023? As you can see, it should be less than $350. That means that currently gold prices are more than 5 times overpriced. Well, this is the way when I put a practical example of those issue valuating benchmark, because just simple like that 4760 in 1972 is the same item will cost now $350. But there's other thing to take into consideration, because mining an ounce of gold in last year average around the world is a bit less than 1300 ounces, and it had 18% inflation rate from 2021. So it's not possible to have a gold price over 3 times lower than a mining price of gold. Mining of gold price costs. So it's kind of obvious now why I claimed there are some issues regarding valuating a gold price and saying if it's overpriced or it's undervalued. By the inflation, looks overpriced. Even when we look on the average costs, it's also overpriced because 40% margin, it's a huge margin. But we'll take a closer look at the end. Big Mac Index. I literally love Big Mac Index because it has its purpose, and the only issue with the Big Mac Index is how popular McDonald's is in every country, in every region. Because if you need 3 people to run the McDonald's restaurants per shift, so if you got 24/7, it means you need 12 people. And let's say those 12 people in 24 hours can serve 2000 sets, whatever, 2000 Big Macs. But they've got 1,000 customers, so they buy the goods, the buns, the meat, the tomatoes, the salad, the cheese for 1,000 parts, but they still will have to pay the minimum amount mostly of money to the employees. And if in that country the Big Mac will become more popular and they will start overnight serving not 1,000 but 1,500 Big Macs, so it will be still within capacity of the employees, and it won't rise their cost. It will reduce their cost they will serve more, so it will be less work cost in a Big Mac price. So it's great index. It's a great idea to set a Big Mac index to evaluate currencies, and now we're gonna evaluate it against the gold. But it also has an issues regarding how popular big or McDonald's itself is in the world, in each country. In the United States, we know it's very popular, so there is probably more customers than the typical basic staff team can serve. So they will probably hiring more people than minimum. Anyway, January 2023 in US dollars, United States were quite high, because as you can see, there are number 8 here. We've got Switzerland in the beginning, then we've got Uruguay, Norway, Sweden, Denmark. It's not really surprising that Scandinavian countries are really expensive. Argentina, with their huge inflation, unofficially reaching 100% per year. It's really surprising. Low. Then we've got in Euro area, which is also an average, because Euro is now in, I think, maybe 20 countries in Eurozone, in the European Union. So it's also an average, because we've got poorer countries like Greece, Italy, Spain, and we've got richer countries like France and Germany. And then we've got United States, slightly above Australia and Lebanon, but it is. So we've got here United States, as I said, on the number 8, and here we've got the graph I made. I take a 1986 prices. I took some simply numbers from certain years, 2000, so it's from January, so it's before dot-com bubble exploded. It's 2003, it's after setting down. 2007, beginning of the crisis. 2010, end of the crisis. 2012, right after first historical heights on gold. 2016, I took it right before, right after Donald Trump take over the White House. 2020, pandemic, and it's also January, so it's before pandemic reached United States and Europe. And then 2023, and it's also January, as we can see. And this purple line showing us burgers per ounce of gold. So as you can see, before financial crisis, we are able to buy less than 250 burgers. We had also less than 250 when Donald Trump overtakes White House in 2016. So now reaching 400 burgers per ounce of gold is suggesting that gold is overpriced, because we are really near to high. So is those Big Macs are not evaluated properly, or the gold is overpriced? It's really hard to say at the moment, but considering this and based on our assumptions for this show, it's underpriced. And now we've got real estate in USA, rate of return, it's here. House price index, January 1991, July 2023 is a little bit over 300% return. The gold in the same period, 435. So if you buy your house in the beginning of the 90s on 20th century, you should buy gold then. So it's for me as an investor, it's a bit surprising, but yet, okay, that's the numbers, right? That's the numbers for United States real estate market. We can see easily that there was some little bubble on the market in 2006, it started dropping in 2007, and return in 2012 to rising, reaching the same level in 2016, so also right after Donald Trump take over White House, and it's keep rising under Joe Biden's presidency. So what's the real estate gold ratio? And I found this showcase home price index gold ratio. We've got house price in USA in January 1991. It was less than 332 ounces of gold. And in July 2023, it was 286, almost 286 ounces of gold. In the meantime, we've got maximum when there was in 2001, when we've got dot-com bubble in the middle, so when gold was a bit lower and the house price were higher, it cost us 772 ounces of gold. Minimum was in November 2011 when gold was reaching first historical heights. It was less than 140 ounces. So considering this, I might say that the gold during the real estate gold ratio is undervalued, as housing were more expensive during the time, not only because of the land, but especially with the construction materials price rising and work cost is rising. So it's really surprising, but real estate gold ratio showing that the gold is undervalued. So stock market rate of return, we've got here S&P 500 total return from April 1988 to July, it's 3,000 almost 700%. Gold return, we know that it was a bit more, but as you can see, it was a bit lower in 80s. So we've got 332% return from gold. Of course, buying S&P 500 total return index would be better than gold. But S&P gold ratio. With S&P gold ratio, we can easily see that the price in gold in April 88 was 0.6. On the gray marks, we've got some crises, and so it's here. In July this year, we've got 2.34. The maximum was in August 200, when we needed over 5.5 ounces of gold to buy S&P 500, and it was the middle of the dot-com bubbles, and we've got minimum in August 2011, 0.7. So it's higher than in 1988, but it's a minimum after this first rising tops here in end of the 80s, and then from 90s we were above those levels all the time. So according to this, I might say the gold is a bit undervalued, because as we can see, the S&P 500 total return rises over 3000%, but the price in gold rises a bit more than 4 times. It's bigger than the total return ratio from the gold in the same period, but yet it's probably like this. So let's follow to supply and demand, and here I might be a bit controversial, but it might be also true, as I take a look on the commodities market for many years now, and what I saw in those passing years, that with no extreme demand or supply situation, physical supply and demand are not important for gold prices. An extreme, I mean, for example, problems with mining in one of the largest gold mines in the world, Muruntau in Uzbekistan, Carlin Gold in USA, or Olympic in Russia. Why is this important? Because we have some minor issue in smaller mines around the world every time. People, unfortunately, are dying in some accidents in the mines in South Africa, in Russia, also in United States or Canada. But even if they stop mining, or there is some company saying that we're gonna mine, I don't know, sometimes even 200 or 300 ounces less than usual, it's not affecting the price on the market, on the futures market. Why? Well, I think it might be linked to the truth that in futures we have much more gold, many times more gold than it is on Earth, including the one still in the mines or somewhere outside the mines, so one that we didn't mine yet. That's why I think the only extreme demand or supply situations might affect those markets. So what's the general idea? Undervalued or it's overvalued? We've got geopolitical situation overvalued. Central banks undervalue because they still buying gold. Silver ratio a bit overvalued. S&P 500 gold ratio undervalued, but inflation overvalued huge times, especially that it's still over 30% margin on it. Big Mac index overvalued. House price index, which it should be considered only as a real estate gold ratio, it's also overvalued. But this is what comes from the numbers. What I take mostly is central banks and geopolitical things that should be taken into consideration when you want to buy gold. Why? Because central banks, really, come on, they're not stupid. If they printed money, they knew that it's gonna be inflation costs. They might say they were surprised, but yet it's kind of obvious. If they didn't have any inflation in a much longer period of time, they will probably have to rewrite all the economical books, and there will be some new economical Nobel Prizes, because there will be printing money doesn't make an inflation. Completely new idea. But as far as we know, as same as physics laws, the economical laws doesn't change. They might be suspended, they might be waiting, they might be pushed away from the current moment, but they will come back. We had a perfect example in the United States in 2021, 2022, and also still 2023, which is above the Federal Reserve target rate of inflation. And also there is a question of inflation. Do we really can say what I said already when we showed this information about the inflation price that should be on gold? Because I show you why it has to be much higher than purely inflation price. Of course, it might be a benchmark problem, not only with the mining cost in the middle, but also that in January 1972 the gold was much more undervalued than it should be. So that's the idea, and my personal opinion is, and please remember it's a personal opinion, that gold is undervalued. This is not an investment advice or recommendation, it's just my personal opinion that gold should be much more higher than 1950 or $2,000 per ounce. As same as gold and platinum. Palladium not. Gold, silver, platinum are undervalued according to my knowledge, according to my opinion, according to the fundamentals of those markets and fundamentals of those situations. And because central banks are supporting my opinion of undervalued gold prices, because they keep buying, it might be really, really interesting. So please subscribe to our channel. Please like and share our video. Please leave a comment if you wish to share with us some information. And I thank you for your attention. My name is Bogusz Kasowski and I am running Macro Point of View, macropov.com, which is the website I strongly recommended for you for the not only commodity news, but mostly focused on the commodity news, as commodities are running our world. Have a good luck on the markets, have a nice day, and see you on our next show. Goodbye.